started working, at some other investment firms, then you started to bring in spreadsheets and macros, and then you started doing some quantitative work. Then you were talking about back rooms and servers and server rooms, and then you talked about having a real tech department, but things were still, and yes, it was more efficient, it helped with cost, it helped with performance, absolutely. Some of the best hedge funds around, they were very early pioneers of taking in data. And they've been doing that for 40 years. But all of that, all of that technology and progress that they had, it was kind of, it was like linear technology. It's like you tell a program to do X, it's going to do X, no matter what. It'll do X forever, even if X is not working. And that's how really Wall Street grew. And then I worked at an asset management firm. Eventually, I was hired in a family office for these very wealthy families where, we would run their money for them. We would manage it for them, and we would invest in everything from little ETFs to hedge funds and private equity and so forth. But again, it was all manual. But that's even up until, 2008. But we started seeing significant improvements in that manual process about 2008, but it completely accelerated with COVID. And I'll give you an example of what we're doing now today. And now we're doing something, instead of being very much entrenched in Wall Street and kind of that institutional brokerage, Goldman Sachs kind of, Morgan Stanley kind of, environment and ecosystem. It's shifting. It's shifting now to like PhDs and quants, and you got Silicon Valley. And I'll tell you, I've got a partner who is, a firm that I partner with on the AI side for. They're one of the best AI firms in the world for investing, and they're in Madrid, Spain. So it's like suddenly, things are, disintermediating, and things are getting, spread out. And where you have the banks and brokerages firms in the past, that controlled the flow of information and products and services and really impacted prices and drove prices, that is completely, absolutely changing. So here's a perfect example. So when I started investing, if somebody said, hey, I just sold my company, I'm a tech entrepreneur, I sold my company, I'm worth $100 million. I'd like to hire you to be my, CEO of my family office and to invest my money. And we say, fine. Well, doing the asset allocation, sitting with the investor, having back and forth, doing spreadsheets, looking at analysis, then going and traveling around the world, finding investment managers and hedge funds and investing. I mean, it would take years to put the portfolio together. It was so complex, so manual, ridiculous in its complexity and its time suck, and then all of the infrastructure that you have to put in place. And what we're doing, so this is leading into the firm that I'm doing now. I want to take that 6-month period, and up it, which is probably years, I want to condense it into an hour. So we're going to condense that entire process for investing into an hour. And the cool thing about that hour, 45 minutes of that hour is just the computer running through the simulations. So for the investor, the guy worth $100 million with his finger, and an iPad sitting on the couch, he'll be able to invest $100 million with his finger, and he'll have AI that'll run it all for him. And he can do it in a completely custom way. So the year's work of work and research and travel and hiring staff and people and all that stuff. I mean, we don't need any of that. And that's what we're seeing in technology today. And so that brings us into the fintech world. I don't know how many of you have kind of, either heard of fintech or kind of know what it's all about. Some of you probably love it, and some of you probably have never heard of it, but it's financial technology. And it's, here's, can I do a share screen?
You should be allowed to, yes.
I think it's this guy here.
So it should be on the bottom of your screen where it says, it's like a green box that says share screen.
Yeah, I'm just trying to confirm which one. I have you have no idea how many screens I have open right now.
No worries.
Here we go. So this is just to start. This is my company here, Lumenai, and we're in the fintech space. And you have other fintechs that are around. For example, here's a site that categorizes a whole bunch of fintechs. For example, you have Wealthfront, Betterment, Acorn. Those are all pretty well-known fintechs. SoFi Financial is another fintech. You're having these fintechs become huge unicorns and going public at 45, 50, $60 billion valuations. So the growth in the technology area of finance is completely exploding. And in my space, it doesn't really exist. So we're like super early on this. Here's one of the cool things about what we're doing and what AI can do for you, but what we're going to do in investment management. In investment management, our goal is to, we want to take what is a $55 trillion market and again, shrink it down where it's completely easy. It's so efficient. It's so simple. It's so, it's risk managed. It's monitored every single day. There's no conflicts of interest. They don't, it's a lot cheaper. So there's all these benefits to this kind of a process. But here's like a real life example. So we have a family, a very wealthy family that we're investing for in California, in LA. And they're very focused on the environment, climate change, carbon footprint, et cetera. And that's how they want to invest. And as a matter of fact, this family even created a private equity firm they invest in technology around climate change and so forth. And so what we did was we went out and, through this process, this is just a screen, but, through a completely computerized AI-driven process, we're able to not only take in all of our forecasts and process on the investment side, right, of what we think of just markets and individual stocks, right? We like it or the machine likes it or it doesn't. But then we'll put together, inputs from the client. And the client may say, look, I want climate change, I'm very focused on that and I want to see proof for it. So with AI, you can put that in and we completely, we built a completely custom prototype portfolio for them that once it's designed and we train the AI on it, using machine learning, it will just execute every week for that client. It'll monitor every day. It'll go through 50,000 security prices every day. It goes through 200,000 different scenarios of what could happen in the future. And then it runs pattern recognition on the past. It says, okay, I'm doing pattern recognition of what's going on now, and I'm comparing it to the past. And it may say, for example, I've identified 17 patterns that are driving markets right now. Basically, you could collapse those into two categories, let's say. When it recognizes that pattern, then it looks and says, oh, I've seen this before. And what do you know? These are the securities and the assets that perform best afterwards for the next 6 months. And so that's what the pattern recognition does. And humans just can't possibly do that. So, so in this ESG or impact or SRI, they call it socially responsible investing, in this portfolio that we designed for this investor, we're able to take them through. Here it is. This is an example. You can go down to the level of seeing how Hasbro treats its employees. Here's Costco. We can see its carbon footprint. We can see its carbon footprint in every store, every state, every store. We can see every day going up, going down. So it's amazing. Here, GM. We see why are they getting bad grades on a socially responsible, governance-oriented kind of screening method? Well, because they're really bad in certain areas like poverty, health, education. Obviously bad on clean energy are not helpful, right? So, but very negative on clean energy and climate action. So, the AI will pull these things out. And the neat thing is, let's say go back to Costco. So, and by the way, Goldman Sachs and JP Morgan, all the biggest firms in the world could not do these things 5 years ago. Now we're bringing it down to our, to our level, the wealthy of us, but we're bringing it down to the level where you don't have to be at a bank or an investment firm and be beholden to their, kind of, biases and their conflicts of interest. So just going back to how it's easy. So here's Costco. AI. So once it's in the portfolio, the traditional approach for impact investing would say, okay, it's in the portfolio. We'll check it out a year later or something like that. We'll run another screen. Now AI is going to watch it every day, and literally, if it's not meeting its publicly stated guidelines and goals, it gets flagged, and then boom, they get kicked out of the portfolio. So this stuff, so we're doing this on our level, and it was not even possible for anybody in the world to do it 5 years ago. And this is part of the trend. So all those things I was talking about before, it's not to talk about how my good old days and all that good stuff. It's about talking to you about the impact that technology is having and what I've seen in the acceleration that's occurring. And COVID really accelerated. COVID, at least where in my area, in finance, COVID broke it open, the entire industry completely open. And it's going through massive and absolutely massive reshuffling as we speak. Right? If you're not equipped to be digital, mobile, on demand, completely customized, right, efficient, price competitive, all those things, if you can't be all those things, you're just not going to compete. And I don't know, think how many banks you've walked into and it just kind of seems musty and old, and things are slow and everything's by paper, and right, it just feels horrible, right? Those are the players that are going to get destroyed, and they're going to get destroyed in every aspect, whether it's insurance companies or it's, and I'm saying competitively destroyed versus competition, whether it's insurance companies or asset managers or retirement funds, hedge funds, whatever it is. You have to, every aspect of your business now has to be around tech. So here's another thing that's really cool using the AI on impact investing. And by the way, impact investing in the US, most professional investors or institutional investors, when they hear of ESG, that's environment, social, and governance, right? Or SRI, socially responsible investments. Or another way to say it is impact investments or sustainable investments. So when you would mention sustainable investments to somebody, usually people in the US would be like, oh, come on, that's, is that like the climate people and, all that other kind of thing. And well, what we're finding now is it's unbelievably in demand. It's the fastest growing segment of the investment industry. 93% of all of the flows of new money from institutions next year are going to go to SRI. Right. So the days of just going to be the S&P 500 or something like that. Now you got to know how do they treat their employees, right? How bad a carbon emitter is it, right? And you can do it on a local level or a global level. So you'll go through all of those things. Here's a perfect example: 2 different car companies, GM, VW. Right, one is very positive and supportive in certain areas, and one is not. So even within the same industry, you can have much better companies, at least on the climate change, range of things or spectrum. And certain companies just don't make it. So we have an investment and risk screen on the one hand that we would do, and then on the other hand, we would have an impact screen or an SRI screen based on exactly what the investor wants. And the investor, it could be their religion. It could be Muslim. It could be Catholic. They could be Jewish, right? So you can literally put in constraints in that, and you can see scores. I'm trying to think how to say this. You can see scores where you can actually see who is kind of, if you're Jewish, you can see who has, at least neutral, if not positive impact on, Jewish communities. If you're Muslim, you can see Sharia, does it conform with Sharia law, things of that nature. So this is all coming down, and it's all being done very quickly. And again, if we can get this down to 15 minutes for an investor, down from like 6 months at best to probably multiple years. By the way, so we take all of this, and I'm going to show you a portfolio, and we just build all these portfolios. The green is the benchmark, and the blue is the portfolio. So we'll look at risk. We'll look at where does the risk come from? How many times does the portfolio, do you see run-ups? What about drawdowns? How did it do in different years? Right, all of these things. We show them the holdings, all chosen by AI. every stock. I'm going to show you how AI caught, how it learned about the coronavirus. It taught itself about the coronavirus in the market. And then it completely changed the portfolio.
Your screen, by the way, is stuck on the age of self-adaptive investing. I think it's stuck on that. I don't know if
God, you guys were missing some really good stuff here. I'm sorry.
No worries.
I'm sorry.
It just happened recently, so no worries. If you can't figure it out, that's fine.
I'm going to stop share and then I'm going to share again.
Appreciate that.
Sorry. Here was the example I was giving about GM and VW. Yeah, we can literally go through, there's 150 measurables in the ESG space that we can look at GM and compare them to VW. And so we know exactly, you can make it so narrow, it's unbelievable. This was the portfolio that we built here. This green line is, you see it now? Yeah. The numbers are small. I apologize. It's just, they're not great for projection. But the green line is the benchmark, which is the global stock market, and the blue is the client's portfolio of sustainable companies, all sustainable. And so what we're doing for them is, what are we doing? We're getting better returns. Well, in this case, we're getting 150% the return of the benchmark. So you'd have another 50% of money after 10 years. And we have less volatility, less risk. We're getting better returns, less risk, and that's what AI is. And that's what we mean by efficiency. When we say efficient, this is an efficient portfolio. I mean, you're getting great returns and you get less than market risk. And here's an example of that. This is return. This is risk. The further out you are, the riskier you are. This is the index. And this is return. The higher up you are, the better. And this is the portfolio we built for the client. Higher return, less risk. This was the list of the holdings. And I'll show you another screen. Let's see, is it this one? Yeah, here's what, here's what AI did with no training at all when the coronavirus hit. And in January of 2020, I can tell you right now, the portfolio was very much set up for a growing economy. That's what we had, right? Remember, we had very low unemployment, right? Everybody was working, things were great, interest rates were low, people were, jobs were people were happy with that. So we were set up for risk, right? That's what the machines, set the portfolio up for. It says, hey, this pattern, we recognize it's a good pattern. We want to be more in stocks. So that was really around here, this period right here, you can see. Period right in there. This is just before, here's the time frame. So here's January 2020, we're right in there. Then COVID hits, look what it did. It just, it completely changed. This blue, by the way, is stocks in this particular portfolio. The gray is cash, which doesn't change a lot. And the dark green is bonds, like treasury bonds, municipal bonds. And this light green is commodities. It could be oil or gold, things like that, copper. And this is how much of it is in the portfolio. And your portfolio always adds up to 100%. That's your whole portfolio. So here you can see during 2008, it took basically gold and cash and bonds all the way down to, 65% of the portfolio from like 7%. That's what it did in 08. It did the same thing with COVID. And, for humans to do this is just really hard for them. Because every decision, you have to make multiple decisions. It's not just, oh, I'm going to make, do I sell? It's not just that. What do you sell? When do you sell it? Okay, then you get cash. What do you do with the proceeds? When do you reinvest the proceeds? And then how long do you hold the proceeds on, for? You got 5 decisions you have to make on one trade. So there's just way too many places to step up. Here's looking at like sectors over time. And again, this is all like COVID. I'm sorry, this is all Fintech. This is happening all over the world. But suddenly, the colors are, the keys are down here. But this pink is telecommunication companies and internet companies. The dark blue is kind of boring, staple companies, like Costco or something like that, Procter and Gamble. The green is financials like banks, asset managers. The red is healthcare. The gray are industrials. This is like John Deere, Harley Davidson. Well, Davidson's a consumer. John Deere makes big tractors. So that's an industrial company. And then the pink is technology. It may look small, but the technology really expanded. So when COVID hit, what did it do? It went into, we saw it sold stuff. It sold the riskier stocks. Then it went into cash, gold, and US Treasury bonds, which generated a positive rate of return. Gold did great, treasuries did great. And then for the stocks that were remaining, which were now 35% of the portfolio, it pivoted those holdings to things like the number one holding. I laugh every time I think of it because I think it's so funny. It's Clorox. Clorox was its number one holding at one point. And like, how in the world did it kind of figure that out? It did it through pattern recognition, that's all. So, so if you go back to what those holdings were before, suddenly you see it kind of, it makes sense. So it's great to have a system that's just super customizable, easy. We can look completely into it and see everything we invest in. And it's faster, and it's had better returns, and it's had less risk, and it's cheaper. So this is why this is going to go this way. And so in the financial system, there's entire banks, asset managers, there are brokerage firms, there are, there's all these firms that are kind of older, and they're just hanging on, and they're doing everything manual, and they're going to get just utterly crushed in the next decade. Here is something done by Ernst & Young. This is brand new. The guy, his head of the head. By the way, I sent this for all of you. I sent this to Trevor. So if you want a copy of this is a fantastic discussion done by Ernst & Young, talking about using machine learning and artificial intelligence in the investment world. So this is like totally, for the US, this is like totally cutting edge. And by the way, way better than Robin. Just so you know, way better. So what's going on in fintech? Fintech, I would not recommend traditional finance. If you talk about a career, I would recommend people be really careful about finance. Finance is becoming so regulated, so disliked. There's just, it's so competitive, right? But in the fintech space, that's applying technology to finance. There are amazing companies that are being built like from nothing and becoming billion-dollar companies because of this perfect storm here. You see this yellow wheel? Yeah. So you've got open source software where you can have people in the industry can write common code. You've got the availability of big data. In the last 2 years, more data has been created in the last 2 years than the entirety of human existence beforehand. And that's accelerating like this. So the data, there's more and more data. Think of all the data you guys create every day. We all do. Phones, right? Online, our purchases. And then cloud computing, of course, everything, nothing in the back office, nothing physical, it's all in the cloud. Now you can even, we're using IBM's IBM Cloud, where we can put up, actually our software doesn't reside on computers down here at all. It's all, the software is literally specialized investment software. It's all in the cloud. So putting all this together, from everything from insurance to banking to loans to payments, right? Payments, are a huge, everything from Venmo to PayPal, right? This is all part of fintech. PayPal's a fintech company, right? One of the first really big ones. So you're seeing all of this, come together. And like I said, if you want this, I recommend it. Get it from Trevor. And, he can take you through that. How are we doing on time? So I would like to get some questions.
We're doing well. If anyone has questions, feel free to interject at any time, if that's okay with Mr. Bailey, and just
Sure.
ask.
Does the AI think it's going to invest in any cryptocurrency?
Well, so my partners, we're going to explore that. I know for a fact there's hedge fund guys that are doing it. I don't think they're not doing it with AI necessarily. There's actually not that many people in the asset management industry. It's the least penetrated industry in the country for AI. So probably yes, but not yet. Anybody else? Okay, so here's an example of some of the work that AI is doing, which is really fascinating. One is clustering. So clustering is a technique that makes sense to me logically. I was not particularly aware of using it in this context before. I want to make sure I have one other screen. Here's another example of clustering. So clustering is where you take an entire bunch of.
You can't quite see it.
It's stick with the. If I go off, it's got like 3 screens. So if I go off, it doesn't work. So here's clustering. Let's say I download the S&P 500. I download the security performance and price of every stock in the S&P 500 forever, as long as pull it all down. And then what I want to do is do my analysis, et cetera, et cetera. But part of it is to do clustering. What clustering is, you're looking for behaviors that are common. If you're investing in similar stocks, well, they should have some behavior that's common, right? How much risk they have, how much return they have. They should at least be near each other. Kind of like, have you guys ever seen like flocks of birds? They create this changing, modulating cloud, cloud of birds. They have what do they call them? Bait balls, with fish in the ocean. So you can do that with securities. And when you do it with securities, the nice thing about that is you can instantly find the outliers, like right away. It's so obvious. And so what are typically outliers? Either fantastic, really talented performers on the one hand, or a fraud on the other. Usually what it tends to be. So, okay, but what we do in this case is we just, anything outlier, unexplainable through data, boom, gone. So that's what clustering in effect does. And so we could do that on 50,000 securities. And then we can also, you see the size of the balls, this can also do a ranking for the attractiveness. So clustering plus attractiveness. And so these are the things that we're bringing. We're bringing, we can look at every security's momentum. Is it positive or negative? How much liquidity and trading volume can we have in something? We can look at all of the risk factors. And then we can see how they behave with each other. The best thing is where you have things that are just different. They don't really correlate with each other. That's where you get the magic, the true free money, literally the true free money of diversification, right? Which is it's not always perfect, but you can do all of this analysis on every single security. You do a rank, and then from there you can start building portfolios. And then you do all these simulations and tests on the portfolios to see how they perform. And that's what a lot of those reports that we did, right? So this was something we did for an investor. We did it for a foundation. And so we're showing them, like, here's volatility, here's the losses, how we're only, in 08, we would have only been down here, their portfolio would have been down here, those kind of things.
How did you meet your partner from Spain? Just curious about that.
Yeah, this was something I talked to Trevor about. It was relationships. There's a gentleman he's a professor at Cornell, and he's very focused. He's one of the leading practitioners in the area of artificial intelligence in investing. So it was a friend. He became, through a network. We were connected professionally and built a relationship. And then, as I was talking about what we were looking to do, or what I was looking to do, using my expertise and relationships that I built through all of those hedge fund years, investing in hedge funds, we would see 500 hedge funds a year every year. And this guy he was voted Quant of the Year twice. So best quantitative researcher in the world in investing twice. He said, "I've got a great group for you in Madrid, Spain." He told me the name. I'm like, I've never heard of him. And you know what? It's been perfect. I kind of like that, actually. Here's the group, by the way. It's called ETS Asset Factory. And they're just really good quants. This is one of their longer track records. So on this portfolio here, I was going to show you. They've got a 21-year track record of, this is their portfolio that they built for a very well-known bank you all know. And then here's the index. 21 years of also generating an efficient return, meaning for the amount of return they're taking, they have very low risk. I mean, they're getting 6.1% per year for 21 years with very little, almost no volatility, like the volatility, less than a bond, less volatility than a bond would have. I mean, that's just talent. Anybody could do it for like 18 months, 2 years, 3 years. But that's ETS.
I had a question.
Sure.
The AI, like, what's its average return on investment year to year? Because I know the S&P 500 is about 7%. So I was just curious how the AI compared.
Depends on what portfolio you build. But if, for the S&P is like a very, very efficient market, right? At the end of the day, to beat the S&P index, it's not easy. So what it does is it basically generates, we have a module S&P only, it'll outperform it slightly, but it'll do it at 25% less risk. That's the generic, we don't touch it at all. A cool thing is we're building a portfolio for 2 professional investors. They both run asset management firms. They're doing a partnership together. They're managing $3.5 billion in just one of their companies. So experienced guys, but we're building a portfolio that's the NASDAQ. So it's all technology and healthcare. And it's gonna be long, short. So we can invest in good things long and then kind of short bad companies that we don't like or we think are gonna go down or are gonna have poor returns. And there you can have better than market returns with less risk. Doing something like that. So I don't know what the numbers are going to be. We'll see, but I think they're going to be. We took a first pass and it was like 19% per year, but not a lot of risk. That's the thing. Very modest risk, less than S&P 500 risk. Have you guys ever seen like the risk of like Bitcoin? It's like, you have the risk of bond, cash is no risk, right? Then you have bonds on top of that, a little bit more risk. And then you put large cap stocks on top of that. Yeah, now you're getting more risk. Then you put something like gold, a lot more risk than even the stock market. Bitcoin is it's like 4x above all of those. It made gold look like a bond. Like it just made it look pedestrian. So that's insane, crazy, but we'll see. There's some pretty smart minds that are working on it. There's one fund I'm trying to remember, which I think is the largest fund. I can't remember the entirety of the name. Is Grayscale, Gray something fund. I can't remember. But look them up. They're excellent.
Yeah, so if anyone has any questions, feel free to unmute and ask Mr. Bailey. I'm sure everyone's interested in hearing more about it. One question I had was so obviously you're kind of familiar with the Securities and Exchange Commission if you've worked in investing for some time. How do you think their handling of the GameStop issue back in February when Robinhood shut down trading is going to impact the future of the financial markets and, trading in general?
I don't know how it's going to affect trading in general, but I think it'll affect, certainly it's going to affect Robinhood, who, I opened an account with him one time and I literally, I was, did some leverage and margin, did trading, whatever. I couldn't figure out like what my account balance was because they're all these metrics and numbers and it was like, you hit this button and like, I literally couldn't, and I had to nail them down to figure out what it was. So I think they're going to, that's like that's like nothing, right? But I could see how people could suddenly, you could have levered like and use that to buy options which could have expired completely worthless, right? Zero in 30 days, right, or less. So it's that there's no like safeguards at all on that thing, which is not good. And also, frankly, it's a what we call like a dumb process, meaning there's no smart decision making to it. It's like if you press X, it'll buy X. That's all it is. But I think Robinhood's going to have a very difficult time. I don't know about trading. More broadly speaking, I will tell you the incoming SEC chairperson, it's a woman, is I know going to be aggressive, much more aggressive. I know the Biden administration is going to be more aggressive. So it wouldn't surprise me if there is some kind of trading bumps that go through. We'll see.
Thank you.
For Lumenai, what's the strategy for marketing to get the word out to people that are younger and make it more mainstream, I guess, the way of AI investing? What's the marketing strategy, in your opinion?
Yeah, I mean, you know, we'd love to do that, and that's part of our plan. But the reality is, for us right now, we can't do it. You know, we just launched. I mean, we literally just launched. So it took about a year. It took about 18 months to like plan the firm to and then it's taken like a year to kind of get the infrastructure and things going. And then, by the way, I'm in a good mood because today we signed up our first institutional client, our first big client. So so that's a big milestone for us, because once you get one's always the hardest. And once you have one, we had individuals, we had some smaller accounts, and we had past clients, but for anyway. So our path is, I think we're going to be doing a lot of institutional work because it's you know, like these guys that we're doing this tech fund for. You know, we talk to them, but you know who their clients are? Their clients are Merrill Lynch, UBS, you know, Bank of America. That's their clients. So suddenly we just have one client. That's all it took to meet and see. But the leverage is our client can grow dramatically, and you know their clients under them can grow dramatically. There's no way we could ever touch, you know, 100,000 investors. So eventually, one day.
Hi there, this is Ben. Thanks for coming in. In the Lavin Entrepreneurship class that I'm in, along with Trevor and a couple other people on the call, I'm working for this company it's a fintech company that's working on fractional ownership for ultra high net worth art. And so I've been learning a lot about that fractional ownership piece.
What did you say? Did you say ARC?
For art.
Oh,
like
okay.
multi-million-dollar art.
Okay.
And so I've been learning about, you know, basically now they have like a stock market for shares of art that's been growing at like 120%. I think it was over like 5 years or something like that, and outperforming the S&P 500. And I'm just learning a lot about this fractional ownership stuff. What are your thoughts on how that's going to play into all of this AI-based stuff that you've been talking about?
The things like art?
Yeah, fractional ownership of art and collectibles, and then we're even getting into like NFTs now and all of that.
Yeah.
So what are your thoughts on how
our plan
is going to change?
I'll tell you our plan. Our plan is we're starting now with, you know, stocks, bonds, cash, you know, credit, high yield, you know, commodities, things like that, tradable, right? Futures, options with it. But on the one side, but on the other side is what you're talking about, which is, so I'm going to answer this in two parts. There's the fractional, which frankly I don't know a lot about, but I know they're going to be, you know, there'll be more of them. Everything from like Warren, you know, Buffett to Tesla and so forth. People can't afford to even buy like one stock, right? So, but I know firms are kind of rolling it out, like the Schwabs of the world. You know, so you've got the fractional ownership item. And what was the second one? What was the fraction? Of the art, the collectibles. So the private investments. So it's not, so yes, collectibles, right? Art, but also things like we're like looking at, when we say real estate, we're not talking like something you trade, we're talking about a building, right? We want you to be able to buy through a digital transaction, you know, be able to invest in that building, that building, that building, you know, and art would be an example of that. And I know guys right now that are working on platforms. There's a guy that I know, he's in New York, and he used to work for Tiger Management, and they're trying to build infrastructure for all that private stuff.
On the real estate side?
For anything private equity, venture capital, real estate, all of it. You know.
Very cool.
And on the art, by the way, just, you know, you have to look out for, right, I mean, the disaster scenarios are, you know, fraud, right, of the art, number one, and then provenance, right? Even if it is a Van Gogh, is it your Van Gogh?
Mm-hmm.
Or was it taken, you know, in war, you know, kind of thing. So you got a lot of fascinating topics going on in your company. Sounds interesting.
Cool world. Yep.
I think you're working on something neat.
Oh, it's not my company. It's
But you're
a
still
company
working
I'm
on it.
working for. Yeah,
You're contributing, so that's awesome. Soak up everything you can.
absolutely.
Hey, John, thank you for coming in. It's been super interesting to hear about your company and kind of what seems like a revolutionary development with AI in the investment industry. I guess my question would kind of be for those interested in finance and going into the finance industry, and specifically those who are entrepreneurial minded. Given the nature of AI and where things are going, what skills should people be learning in college? How should people kind of be adjusting their career paths in college, and then kind of first steps into the industry now with AI, and how do we contribute to that growth kind of starting now?
Mm-hmm. Well, if the financial aspect or the financial industry, if that kind of AI or tech is what you're interested in, kind of fintech, you gotta there's the headhunting route, but I'll tell you, that's not, we all know, right? That's not a high reward, or high probability event there. I would go straight to the people in the companies. Because frankly, I wouldn't have Lumenai, I wouldn't have my company if I didn't do that, right? I reached out to this guy named Marcos. He made the introduction to my partners in Madrid who I never met whatsoever. So all this came from just one phone call. So, if there's companies in your area, look up fintech, look up, any of that stuff. I would definitely, get in there. Personally, I would get in there on the phone. I would get in there physically when I could. Just have informational meetings, whatever it is. I would do whatever I had to get in. Once you get in, that's good. But just be careful, because there's like old finance, and there's a lot of those jobs, right? But those jobs are going to be very unsteady and maybe not that, rewarding, and maybe not even, both mentally and monetarily. But those are also fine for getting experience, getting in the door, and then kind of, learning a little more. There are these hot pockets of areas. There's like Silicon Valley in New York, and of course you got San Francisco, but whether it's San Diego or it's Austin or wherever you're from, there's probably other areas. But if you do go into a fintech, just make sure you understand the cash flow situation. Because they could look really cool, but they could be burning like a lot of money every month. Which is fine if you know about it, but I would want to know about it.
Right. Yeah. Thank you. And you touched on relationships, and I think that's definitely important. And so thanks for touching on that and those tips.
Yeah, I mean, I was talking to Trevor about the relationships all of you are building right now, with professors, with other students, working on projects, people that you might not have met, introductions maybe to other professionals. You've got a beautiful opportunity to, and don't underestimate the value and the strength of your personal network. But it's like a plant, it just has to be watered. Has to be paid attention to and watered. You can't be ignored, because then it dies.
Right. Thank you.
Mm-hmm.
All right. Do we have any last questions before we let Mr. Bailey go? We have about 8 minutes left in the meeting, so feel free to unmute and ask a question. Go ahead.
Yeah, I got one question. Can you hear me out, Mr. Bailey?
Yeah. Yes.
Okay, great. So my question is, what factors or variables do you take in to decide, if a company is good or not? Like besides stock price or liquidity ratios, is there any other factors?
You mean investment wise?
Yes.
Yeah, the hard thing is just incredibly, it's just incredibly detailed. I mean, there's
Okay.
an enormous amount of factors and the timing of factors. And then, but the other thing you have to realize is in markets, things go through cycles. Things work for a while, then they don't. We talked to some of like the brightest hedge fund, quant guys in the world. Everything from Renaissance and Two Sigma and D.E. Shaw. I mean, those are probably the three greatest firms in the world for quantitative investing. And they'll tell you, like, at any one point in time, 40% of their models, are just not working at all. So markets are, so it gets, I guess it gets turned off for a while and then it'll turn back on later. And
Okay.
so it's that answer is it's constant R&D and constant change. And old patterns are always going to be different.
Would you say it's very random?
So I'm sorry?
Would you say it's very random? Like you can't really, with the variables you take in, you can't really.
In the market, you're saying, in the stock market, like price to book, things like that. Well, the problem is when something becomes commonly used, like price to book, it doesn't really do anything anymore, right? Okay. So people would say, oh, the value factor, now we have an ETF, it's got a value factor. Well, value's been terrible. But none of those factors have worked as well as promised. Because why? Because they became so popular and everybody jumped into them. And then suddenly, how are you going to keep pushing up the stock price? There's no additional buyers that are interested. So you got to do the R&D constantly. You got to shift change. There are no generic rules anymore. I think you can't just say price to book or PE ratio or whatever. And, but momentum's another area that I would look at.
Momentum.
It's been very helpful.
Okay. Thank you.
Thank you. Thanks everybody. Appreciate it. Good luck.
Thank you so much, Mr. Bailey.